So very good morning, ladies and gentlemen. I would like to welcome you to our webinar. This one is 16 in line. Today, I'm very happy to invite here our great expert on equity financing, Andrei Petrus. Hi, Andrei. Who will... Hi.
Hi there. Thanks for having me.
Who will lead you through the problems of equity financing, why to use equity, and some other relevant points that you need to have in mind when thinking about inviting investor on board in developing of your company. But firstly, let me start with introduction of the background of this webinar. My name is Ivan Filis, and I'm part of the Tetra team, which is a project that is supporting the businesses that received funding within what we call Next Generation Internet Initiative. On the next slide, I will show you the background of what the European Commission is doing in the area of developing the internet to be more human-centric and based on trust, resilience, decentralization, inclusion, and stability. European Commission is investing more than 2 million euros into different projects, and on the next slide you will see these numbers. I mean that there is several projects, more than 20 projects so far that received funding, and you can also be the part of this venture, because all these projects are here to support the next phase of new internet that we can do here in Europe, and they provide so-called Cascade Funding. So if you are a company or researchers on or any other stakeholder in this area, you can ask for funding up to 200,000 euros for a development of different aspect of new internet. So far, the whole initiative has funded more than 500 innovators with the small grants and received more than 3,400 applications. So it's very interesting area. And as you can see, the whole initiative already supported the companies or the participants from 36 countries. Next slide, please. And for all these companies and all these funded organizations, we are providing within our project called Tetra, so-called business accelerator. So what can you get once you receive the funding from the NGI project? You can approach us, and you can be a part of the business acceleration. We are providing training via webinars as today, and also our boot camp. So far, we have organized 2 very productive boot camps with our experts, and there are several more in the pipeline. And we are also providing one-to-one mentoring in the different areas. I will show you in a second. And we are trying to build the networks between you as third-party beneficiaries. I mean, those companies receive funding from Next Generation Internet, and other stakeholders like corporates, digital innovation hubs, and so on. More information you can find on our website, business.ngi.eu. And on the next slide, I would like to show you the services we are focusing on, and you can receive advice and specific support. Where we are dealing with advisory in intellectual property, also in the field of open source and the other issues that are connecting with the internet technologies. We are supporting transversal competencies and soft skills in the business development. Then new markets, sales, and business models, how to transfer the results of this project into the market. How to prepare for investment and equity funding, which will be the main topic of today's webinar. We are also trying to get an access to international public contracts, facilitating and preparing the best pitches for the investors and the technology transfer services to digital innovation hubs and the matchmaking services and individual mentoring. So there's a whole a bunch of services you may request and you may benefit of. So we are very welcome to visit us at business.nga.eu. And a little promotion for our next webinar will be directed to the companies that are dealing with open source and Creative Commons. So if you are interested in this and specifically in the intellectual property in this area, so you are more than welcome to participate in our next webinar, which will take place online, of course, on April 21. So this is a very brief introduction, and I will now give a floor to Andrei Petrus, who is working in the field of equity financing for a couple of years, and I'm really happy that he's joining us for today's webinar. Andrei, please, the floor is yours.
Thank you very much, Vlad. So, hi everyone. I'm Andrei. I'm currently working as investment manager in Zaka Startups. It's an early stage venture capital company, and we occasionally do also private equity in stable and profitable businesses. And because this, my experience is also coming from mergers and acquisitions and strategy consulting in PwC. And I'm working together with Ivan as a consultant for Business and Innovation Center in Bratislava. So today's topic will be mainly about four parts. The first being fundraising and how to prepare for it, and some fundraising tips. Then we will cover the venture capital investment model and the whole venture capital cycle. And then we'll move to convertible notes or convertible loans. And then at the end, we'll cover equity investments and the most important parts of shareholder agreement and how to prepare for it. So maybe the most important question, why would you consider an equity investment? Mainly, it is because early stage companies or companies who need external financing, most of them are unbankable. They are in the earliest phase. They are too risky. They are cash flow negative because their high R&D and development cost, and because of the process of validation. The interest payments, which are coming from having debt on your balance sheet, are fixed costs, which are raising the company's break-even point. And equity investment can serve as a really good financial pillow when entering into difficult financial periods or difficult market periods. An equity investor doesn't only provide money for the company, for the growth, but also extensive contacts, experience, and expertise from the field. And there might be even some synergies from the portfolio of the investor and of your company. And usually, early stage companies who are in the field of technologies, they don't really have any assets which can be pledged as collateral to the lenders, and therefore a debt financing is not really feasible. So consider that you have 1 month left of runway in the bank. Is this the time to quickly raise some money? Unfortunately, fundraising is a really complex activity, and it needs a lot of time, both for the preparation, the due diligence phase, the negotiation, and the closing phase. So if you have 1 month of runway left, that's not enough. The minimum time required for an equity fundraising is 3 months, but usually it is somewhere between 3 to 6 months. So really plan ahead and ensure that you have a longer runway when starting to negotiate with investors, because this is not really a positive feedback for the investors that you are running out of cash in 2 or 3 weeks, and therefore you are pushing the discussions to be as fast as possible. So it is better to prepare and gather all of the needed documents for the fundraising and due diligence phase, mainly financial and legal documents, and this will spare you some time during the due diligence phase, and also makes the whole dynamic of the discussions much better. So what's the time frame here? If you send a pitch deck or an investment memorandum to some investment company or venture capital company, usually it takes 1 week to get some feedback whether the company or the fund wants to get in touch with you. And if it is so, usually there are at least 2 meetings. The first meeting will be covered by some investment managers, and the second meeting with more senior partners from the company. So after the meetings, you already spent 3 weeks of basically presenting. After that, all of the needed data to evaluate if to invest or not was given either by the pitch deck or through the meetings, and then it needs to be assessed in an internal analysis in the venture capital company, and this can take 1 to 2 weeks. After that, the investor has enough information to be able to create some term sheet, which will be sent and negotiated. The negotiations of term sheet can or the time can vary, but let's approximate it to 2 weeks. And after you sign a term sheet, which is a non-binding agreement, you are coming to a due diligence phase where all of the financial and legal documents and data will be assessed by external lawyers, and this can take really 6 to 10 weeks based on the age and complexity of the business and so on. The output of a due diligence is usually a red flag report, which is covering all of the most important basically problems which were found during the due diligence and how to solve these problems. And if the problems are solvable, all of the negotiation can be continued during the shareholder agreement negotiation, which is basically the final and binding document stating all of the cooperation between the investor and the company, the valuation, the investment, and so on. So the documents which are required are mainly past financial statements for the financial due diligence, but also the business plan with financial projections and how basically the investment will be used. What is also covered during the whole analysis is how competitive and innovative the product is, and whether you are in seed stage or pre-revenue or pre-product or in the later stages, you always need to have some point of validations. Even if you don't have any product yet, there needs to be a validation at least given by the conversations with future or potential customers, maybe some letters of understanding and so on. So this is the most common mistake we as early stage investors see, that even if we are in talks with some pre-seed or seed companies, they didn't really focus much on validation, and they just thought that the product will be a fit for the market, but this is not enough. Of course, competition analysis and analysis of the go-to-market strategy is very important part of the whole analysis. And if you are in the earliest stages of financing, what do you have is mainly a really good and strong team. Venture capital funds or angel investors want to see the curriculums, CVs of the strong team and get in touch with them. So some fundraising tips. If you are emailing the investors, try to make personalized intro emails and fill them with really interesting numbers, like your traction, number of active users, or revenue you generated, and so on. This will really get the whole discussion forward and make a better picture of the whole company. And if you are in touch with an investor, and even if he says no, always ask for advice and feedback, as these investors might have better expertise in your industry. Maybe they have several portfolio companies from the same industry. So really use this connection to get some feedback and get some market insights. What is really important is also finding an investor who is somehow fitting to your company, to your culture, to your plans, exit strategy. And as I said also earlier, always try to show some validation. Either it is some prototype or minimal viable or minimal marketable product, or some customer insights, customer feedbacks, focus groups, and so on. If the validation is not part of the presentation, we usually try to understand how to get validation as soon as possible and basically prolong the whole discussions of the investment until the validation somehow is proven. What is also really interesting, and I would advise this to be a part of the pitch presentation or the whole presentation discussions, is to discuss not only the market size where you are operating and the competitiveness in the field, but also whether there are some catalyzers which were happening in the past time, maybe some change of the regulation or some new technology which is feasible to be used for the first time, or I mean economically feasible, and so on. So what is maybe also really nice to understand is what are the market standards for term sheets, shareholder agreements, convertible notes, as these standards are sometimes hard to understand if you are hearing it for the first time. And I would like to cover the most important parts of a shareholder agreement during this presentation at the end. Okay, so let's get to the second topic, being the VC investment model. So a venture capital fund usually has a portfolio of few wins and many losses. It is a high risk, high reward strategy. And a good example could be that the VC has a portfolio of 20 companies. 2 of them are returning the fund. 2 of them are really the winners. 3 others are moderate returns. Basically, the investor didn't lose the money on these 3 companies, but all of the rest, the 15 companies, are write-offs. And therefore, if you have 2 companies out of 20 who are returning the whole fund, you need to be aiming for really scalable companies who are also in big markets, because you are looking for at least 10x returns, depending from the stage where you are entering the investment cycle. So small market sizes or some limited geographical focus and non-scalable products, or even hardware products, could be a no-go for traditional VCs. but that doesn't mean that the business is not investable. It just means that the typical venture capital fund is not a right fit for you. So VC is not for every business, and that's completely okay. There are other investment fund types or investor types who are willing to get into more conservative or lower growth stories, and who are focusing more on the profitability and stability of the business and not on rapid growth. So there are different investor types. The first could be a strategic investor who will be adding synergies to your business, and he could also be a future potential exit partner for your company. Then you have a classical financial investor, which is in the early stages of a company, a venture capital fund. In the later stages of a company, it is usually private equity. Then you have, of course, angel investors and high net worth individuals, and they can have their own investment thesis. They could invest only into certain industries where they have expertise in, or they are investing into early stage startups because they just want to learn how the industry or the new technologies are adapting and so on. So they also can have really a different strategy than a typical venture capital fund. So target these investment types or investment groups by understanding if you are scalable enough for a VC, what is your risk return profile, what added value or expertise are you looking for, and what are your exit strategies. So the typical startup financing cycle is the orange line is basically stating the size of revenues, and as you can see at the beginning, your revenues are basically or the profitability is basically negative. So this is the part where angels and seed capital comes into place. Then you are coming to early stages of the company with Series A, Series B investments, then into later stages with Series C mezzanine investments, and heading to an IPO, or in the last months or years, not only IPO is the only exit strategy, but there are also these special acquisition companies who are basically serving as an IPO vehicle for you. It is good to understand how the cycle works, because with your company, you need to just understand that you want to get from one investment phase, or from the pre-seed to the seed round, from the seed round to the Series A round, and how much money do you need to get from one point of the financing to another. Depends, of course, from your burn rate and so on. So if we get from the left side to the right, if you are in the pre-seed, you are raising the pre-seed stage. It is basically the first investment round. It is either covered by family, friends, and fools, or angel investors, also some angel groups, or the earliest stages of venture capital funds. The investment is typically 25 to 100,000 euros. It will ensure you a runway of 6 to 12 months, and it has to be used, or it is typically used to get to some early validation, to create some prototype, and to get key hirings on board. If you are done with the early validation, you can present those numbers and get to a seed investment round, where the typical checks are, let's say, from 100 to 500,000 euros. Of course, in the western part of Europe or in the US, these numbers are much higher. I'm just trying to average it on the whole Europe. So these 100 to 500,000 euros are serving as a cash for next 12 to 18 months, in which you need to get some product market fit, show some early traction signs, and with these traction signs, you are able then to go to Series A and create some pitch materials for the fundraising at the Series A, where you get another 1 to 2.5 million euros, which will ensure you a runway of 1.5 or 2 years, in which you should grow our revenues and get to solid unit economics, which will then give you some good material data and argumentation for this Series B financing round. So try to think long term, try to understand how to get from one investment stage to another, and what do you need to cover during these investment stages. But don't get up too much equity to the investor. We have 6 different graphs here. If we look at the left side, the pre-seed, there are 2 types. In the first alternative, your angel investor invested into, let's say, invested 100,000 euros and got 20% of equity, which is pretty much for the pre-seed stage. But compared to the second variant underneath it, for the same investment, if an angel investor gets 45% of the company, as you can see, if you go later on through seed funding and through Series A funding, at the right in the right corner down, you see that after the Series A funding, founders only have 25% of the stock left. The rest of it is owned by the first angel investor, who got 45% at the first round, because maybe founders didn't know that it's not feasible. Founders were naive, or they didn't have enough validation or revenue to back the valuation of the company and so on. But this leads then to unsustainable cap table, where at the Series A, the funding team only has 25% of the company, and they are not basically they are not incentivized enough to lead the company, because they only have less than minority. So think also about the cap table sustainability. Okay, so if we come to equity investments, there are 2 types. The one being the normal equity investment, where the investor buys stock or shares in the company directly for his investment. The other is so-called convertible loan, or convertible note, or convertible debt. And this is basically a short-term loan that is converted into equity in the future. And this is typically during the next financing round. It is usually done in the early stages of the company, prior to the first VC round, or the first professional VC who is entering into the company in the next investment stage. So what are the key advantages? It's a faster investment process, because the whole documentation is, compared to a shareholder agreement, I would say maybe 5 pages compared to 60 pages. And really good advantage of this is also that the valuation doesn't need to be set yet. You are only setting maximum valuation and the minimum valuation for the conversion in the later round. The investor usually has also a 20% conversion discount, which serves as something which, you know, is a trade-off of his risk. And even though it is a convertible debt or convertible loan, there are no interest payments paid during the time. The interest is typically accrued to the principal and is then conversing to the number of shares. So maybe it will be clearer if I show you some really easy example. So let's say that an investor is granting you 200,000 euros with a convertible note. It has a 20% conversion discount with a valuation cap at 5 million euros. So in the variant A, there is a next investment round, a normal equity round after that. And the second investor invests 500,000 euros at the 4 million euros pre-money valuation. So there are 100,000 shares, let's say, and with 4 million euro pre-money valuation, the price per share is therefore 40 euros. But as the first investor of the convertible note had a conversion discount of 20%, he is basically converting his convertible note to equity at a 20% discount. So he can buy one share, not for 40, but for 32 euros per one share. And after the conversion, he then owns 6,255 shares. So the convertible loan of 200,000 converted into equity worth of 250,000 during the next investment round. So this is one example. The second example is basically the same, but it works with the valuation cap. So the next investment round is the same amount, 500,000 euros, but at 8 million euros pre-money valuation. This means that there are again 100,000 shares, and the price per share is then therefore 8 euros. But as the convertible note holder had a valuation cap in the agreement at 5 million euros, he is not converting at the 8 million euros valuation. He's converting only at 5 million euros valuation, and therefore at a price of 50 euros per share, which will grant him after the conversion then 4,000 shares. So the convertible loan of 200,000 of the first investor gets him 320,000 euros worth of share after the equity round. So these were convertible notes. These are used as I said, in the earliest stages. It can be beneficial for both the investor and also the founder due to the really fast process. But mainly for the founder, the benefit here is that you don't have really equity investors, you don't have shareholders on board. Therefore, you are not granting them any shareholder rights. You only have debt holders. So usually, convertible notes don't grant the investor any investment rights as board seats, veto rights for reserved matters, or tag-alongs, drag-alongs, and liquidation preferences, and so on. So this will give you some cash for the next 6 or 12 months until you get to a really normal VC equity priced round, where the valuation will be set by the professional VC who is buying or getting into the company, and you have complete control until the VC led round of your company, and you are basically controlling all of the board seats and all of the reserved matters. Now we can get to a normal equity investment by normal, I mean not convertible notes, but investors buying the shares in the company. And at the beginning of the presentation, I showed you, the timeline with the negotiation, term sheets, due diligence, then red flags, and then shareholder negotiations. I mean, shareholder agreement negotiation. So, if a startup gets a term sheet, it's basically a slim document which is informing you how the future shareholder agreement, which then will be binding, will look like. So it only explains briefly the conditions of the future deal, but the final terms are then in the shareholders agreement. If you go through a due diligence phase and there are some red flags from the due diligence, this means that the shareholder agreement and the term sheet can vary because due to the identification of some problems in the company or red flags, which are then changing the valuation of the company or maybe changing the whole deal, this can serve as a catalyst for renegotiation. So the core shareholder agreement parts, which is the binding contract, are basically these 9 items here, and I will try to give you a brief overview of these clauses, as these are some market standards on the market, and you will surely, when getting in touch with some investors, you will surely get these in some form in the legal documents. Okay, the first one, investment size and investment tranches. So usually if you get investment from an angel or a VC of, let's say, €500,000, it usually is not paid out in full after the execution or after the signing of the shareholder agreement. It is paid out in investment tranches, let's say in 2 or 3 investment tranches. So the whole investment is divided, and the investment tranches are paid out after some milestones are achieved. And these milestones can be either set by a size of revenues which was achieved, or size of users, I mean number of downloads or active users, whatever. It can be also set by product development, if some product features were developed or not. If the product wasn't developed, then, or the feature, then the company must wait until it is developed to get the investment tranche, or the investment tranche can be postponed until you get some key hiring on board, let's say a CTO or head of sales and so on. So this is, and all of these clauses basically, which I will be covering, are here to de-risk the position of investor in the company, because the venture capital angel investor is investing a lot of money, but in return he's getting only a minority position in the company, because the cap table will be then sustainable and the motivation of founders will be therefore aligned. He needs to somehow balance the minority position and the size of the investment with some legal clauses, and investment tranches is one of them. The second one is a liquidation preference. It is usually of the size of 1 time of the investment, but there can be also 2 or 3x of the investment. But what is usual and fair for the market is liquidation preference of 1x of the investment. So this is a preference to any distribution of proceeds, and with this preference the investor protects these downside financial risk. So an example could be if a VC bought 20% in the company for $500,000, but in 1 year the company went bankrupt, or it was liquidated, and there were some proceeds from the liquidation of 1.5 million euros. The investor does not get 20% of these 1.5 million euros as a 20% shareholder. He can call this option of the liquidation preference and get back basically his whole investment, because he had a 1x liquidation preference of the investment. So he gets from the 1.5 million, 500,000 back. Okay, let's move on to management control. As I covered briefly, investor is a minority shareholder, but has the skin in the game through the money, and therefore usually demands some veto rights for reserved matters, which are basically whether the company can get external debt, if it can raise second round of financing, if it can sell the intellectual property rights, and so on. So these are really the most important parts, most important business parts. And even though you are a minority investor, you want to have a veto right on this, and you are controlling these reserve matters usually through board seats, which are then risking your investment. Okay, so a more controversial or sensitive topic in the VC is the founder share vesting. And this is not only used in VC investments, but also in case of an acquisition. The investor typically doesn't invest into an existing business or existing assets. He invests in the future of the business and future of its assets, and therefore it is very important then that the founders will be also part of the future of the company. So with founder share vesting, the investor is minimizing the risk of the founding team to depart after the investment, and if they decide to depart, it will lessen the impact of their departure. So founder share vesting usually, well, it means that founders own directly some part of their equity after the investment, and some other part will be granted to them during the next 2, 3, or 4 years of their full-time commitment to the company. So usually founders, let's say they sold 20% of their company to an investor, 2 founders own 80% or the rest of the company, and out of this 80%, 25% is owned by them directly, and the rest of the 75% is vested over time, and they are getting this equity with a monthly or quarterly frequency. So in case of departure of the founder, in let's say after half a year or 2 years after the investment, the founder loses all of his unvested shares, and these shares are then bought back by the company or distributed among other founders or other team members, or it can be also sold to an external investor. And this is bringing balance and also sustainability to the whole business, because if there is some founder who after the investment decided not to really bring any value to the company, it is fair that his shares or some of his shares will be then used for other team members who are willing to create the value in the company, work full-time for it, and so on. These founder vestings are also used by in case of acquisitions. So if some strategic investor acquires a company, he usually demands that even after 2 or 3 years, you are working for his company or integrating the company into his, and if it is successful after 2 or 3 years, you will get some part of the exit price paid to you. This is not really founder vesting, but it's the same principle. And the founder vesting is really similar to employee stock option plans, which are I think this is a standard also that the VC-backed companies are having some part of their equity, which is distributed among employees or advisors or future employees and future advisors. It's usually somewhere between 5 to 15%. And as the employee stock option plan incentivizes employees to well, first of all, join the company. You are more likely to join a company where you can get shares when compared to a company where you only get wage. It also incentivizes to stay with the company for long term, because the longer you are staying with the company, the more shares are vested to you. And it also gives you an option to participate on the financial upside of the company in case of an exit. And the principle is basically the same. After usually there is a 1 year cliff. If you are an employee, you need to work at least 1 year to be able to get to the equity from the pool, and then it is vested linearly with the number of months or years you are working with the company. Okay, and we are now getting to the end of the shareholder details, shareholder agreement details, and again, these three are to de-risk the minority position of the investors. So the first one, tag along. It is used to protect minority shareholders. So if a shareholder or a group of shareholders decides to sell their stake, the minority shareholder has a right to sell a proportion of his shares under same terms and conditions. Tag along is not only for the benefit of investors, it is also for the benefit of founders, because if you have a really reputable investor with many contacts in your cap table, he usually has more contacts to possible buyers of the stock of your company. So if he decides to sell his own stake in the company with tag along, he needs he needs to grant an option to you to sell with him the proportion stake, because you don't have the connections on the market. You are not able to get to the potential buyers. But if your investor has the connections, he needs to grant you an option to basically join the sale of part of the stock. Then we have drag along, and this is used to protect the majority shareholders, not the minority shareholders. So usually founders against investors, or founders and investors against employees. So this the drag along enables a majority of shareholders to force the minority of shareholders to join a sale of the company under the same terms and conditions. And this basically prevents the minority shareholders to block a deal. So usually, if you have acquisition proposition from a strategic investor, he is interested only in buying 100% of the stock of the company or the whole company. And if you have some minority shareholders, for instance, it can be some small investor from the earliest rounds who owns 3% of the company, or the founder or the co-founder who is not really working for the company full time, and he owns 2% of the stock. These two people with 5% can block the whole exit deal because they are demanding a higher valuation for their stock, as was proposed to to other shareholders. So with drag along, you can really decide as majority shareholders that we are selling under these conditions, and everyone else needs to be part of the sale, and therefore he's not blocking it, and you can sell to a strategic investor. And the last one, anti-dilution. This is usually effective in a case where a founding team demands a really high valuation in the first round, which is it is uncertain if they can grow the company so fast that they will increase the valuation during the second investment round. If they are not increasing the valuation of the second investment round, this means basically that the valuation at the first round was set too high, and therefore you need to compensate the investor back and grant him some shares basically for free. And this is the most important overview of convertible notes, shareholder agreements, the whole fundraising process. And now we have some 4 or 5 spare minutes to Q&As. So let's get to the Q&As.
Yeah, thank you very much, Andrei, for your really comprehensive presentation. Well, before going to the question, I would like to really ask the attendees if they have a question. So there is a Q&A section here, so you can pose the question there, and we will try to answer them very briefly now. And before going to the first and so far the only question here, usually the question from the audience is if there will be a presentations available after the workshop. So the answer is yes. And also the previous webinars, we already had 15 of them, and some of them were also focusing on the equity investment pitching, and so all you can find at business.ngi.eu at the section of webinars, and so all the previews are here. So the question here is, what if a non-profit firm needed funding? What would be its options? Before I give floor to Andrei, maybe I would like to elaborate on this a little bit. Of course, there's a question if this is a really firm, like non-profit limited company, or is it other type of organization. But for non-profit organization, there's a whole bunch of funding opportunities, like there are the grants, there's like cooperation with the other stakeholders that can provide the funding. And well, if so, well, but of course we can elaborate on this on bilateral basis if you are interested in. So you can contact me or Andrei. I don't mean like only this question, but if you have any further, so you can contact us after the workshop via LinkedIn or the other sources. But yeah, so there's other options. I'm not sure if Andrei, from the position of investor, wants to add on this non-profit area.
Yeah, so my brief answer would be that a typical equity investor is only investing into for-profit companies because of the dividends and the exit potential. But in case of non-profits, as Ivan mentioned, there are on one hand grants, and on the other hand, even though you are a non-profit company, it doesn't mean that you don't have significant positive cash flow. So in case that you have a interesting positive cash flow, you are able to get also some external bank or debt financing for the company.
Okay. And maybe before any other question appear, I have one for Andre from your experience. Well, what are the most common mistakes or that you are facing when dealing with a company that are approaching you as an investor?
Well, as I am in the investing in the earliest stages, it is for sure the validation part, as I mentioned. Founders who created really comprehensive pitch presentation covering all of the market potential and pricing, go-to-market strategy, and so on, but didn't cover the validation part, didn't focus on the validation. They just focused on creating the product and thought that the product in their eyes was the ideal fit for the market, but didn't have any data to back this.
Okay, thank you. And let's take the very last question before we close. Is here laws in different EU countries are not the same, and convertible notes don't exist everywhere, I believe.
Well, first of all, I'm not a lawyer, so of course some countries have more, I believe, more feasible jurisdiction for convertible notes than others. But convertible note is basically just a contract, so you can create it, I believe, in any jurisdiction. But then the question is, how do you enforce the contract? How do you what arbitration courts or what courts do you use to enforce it? So this is the main question to consider.
Okay, thank you very much, Andre. It was really very helpful, I believe, for all the startups that are considering investment entry in their company. I would like to ask all the participants if you have any other questions, or if the business services of Tetra are relevant for you, don't hesitate to approach us. And good luck with your business. Thank you very much for your participation.
Thank you very much. Have a nice day.